Hi everybody, it's Rich Wiegand from ProActInvest.net. Welcome to one of our first videos for Charts of the Week, beginning this week here, January 24th, 2012, where I'll be reviewing essentially what I view from a technical and also fundamental interactive basis, what charts present opportunities for investors going forward. The first point I'd like to touch upon is the interesting development we see in the equity markets. The interesting development is that the Dow is now approaching a key target resistance level of 13,000. Now that's a magical magnet number, which is very important. We're on our way to touch that resistance area. Okay, so let's take a look at a chart that basically shows that point. The monthly chart is showing that we're essentially been motoring out of this valley here, and we're set to test the 13,000 area as we roll up and sort of caress the top edge of this. I think it's very likely. The Dow 13,000 is only about 3% away from where we are currently at 12,660. Another key point to keep in mind is that tech stocks and small caps are leading the way higher. Sadly, more job cuts were announced by Intel as well as other chip makers. And on this news, particularly the semiconductors are rallying here. So we're getting leadership by small caps and technology, which is a healthy thing. What you don't want to see in an upward move in the stock market is when the large caps and the defensive big names lead the market higher. Here's the semiconductor chart. There you see a nice upward sloping support trend line here. We're breaking out of the linear regression lines, and looks like we're on our way to the 3650 area. Another key point to keep in mind is that the central banks, particularly the Europeans, not to mention the Fed, can do only so much now at this point, but QE3 is not out of the question if we fall back into recessionary mode. The Europeans are going to tighten up fiscally. So to compensate for that, the central banks are going to be adding liquidity. And I don't know if you've been paying attention on the periphery, the Chinese central bank has also suggested that it's going to keep adding liquidity and not be as tight as they have been in 2010 and 11. With regards to their own economy. So, and they may be swiping up some European debt along the way too. So they're going to make sure that the situation in the global economy is not going to deteriorate. That's the impression I get. It's also my opinion. I sort of guesstimating here that the Chinese kind of like a Democrat in control of the presidency in the United States. And they also kind of lean towards a socialist bent, so the Democrats are certainly more appealing to the Chinese. So my guess, bottom line, is that I think they're going to pump liquidity into the system, to the global economy, to almost ensure that Barack Obama gets reelected. And so that to me is a bullish development, because if they're going to pump money into the system, that's going to be reflective in a bullish global stock market. So for that reason, we like the not only the U.S. stock market particularly, but we also like emerging markets and emerging market bonds. So let's take a look at the chart from the emerging markets. Okay, here's the EEM. This is the Emerging Market Stock Index, comprised primarily of the BRIC nations, which includes Brazil, Russia, India, and China, among others. So you get a little bit of everything in there. As you can see, let's take a look at the weekly chart. There's a target area here that I think we're scraping right now at 41.76. We've got a little negative momentum here, which isn't great, but look, we've got a nice little development of base building around this second test of support on the monthly chart. So it's not unlikely that we'll be breaking out into the 47 area. On the weekly chart, we do have some positive weekly momentum, and into the 43 area, as I suggest, is another resistance zone. We've got linear regression resistance, 43 level here. Okay, and on the daily chart, look, nice little development, breakout here from the 50 regression, linear regression line in the 100. Upward sloping 10-day and 7-day, exponential in 22. So it's not out of the question for the emerging markets to pump their way up to the 43 area. We like that, and also along those lines, we also like the emerging market bond index, because if the emerging market stock index is doing pretty well, the emerging market bond index tends to do well as well. There's a little correlation there. We have sort of like a consolidation range. So why don't we draw a little bit of a Sort of looks like a wedge, if you will. And then we have another one coming up from the bottom here. As you can see, the emerging market bond index is kind of stable to slightly up. It's not out of the question for the EMB to scrape the 110.50 area. And also keep in mind that at the end of the month, EMB pays out a nice little dividend, because the fixed income bond ETFs pay typically at the end of the month, but some of them pay in the middle of the month. Okay, another point that I have here is that the US dollar euro exchange rate, the ETF for this, by the way, is FXE, ticker FXE. The euro appears to be stabilizing above the 126 level. That was back in 2008 at the high, and went as low as around 120, 118 in 2010, when the first omens of the European debt crisis and the peripheral Europe situation was presenting itself. We penetrated through the 125 level, but we went as low as 126, a little below 126, and we're bouncing off that. We're at 129.70 right here. I don't expect this thing to bounce off this level that quickly, because there's still some fundamental issues with the European currency union, and let's see if we if the Greek debt situation and the default situation there is cleaned up, and if the European Central Bank is going to add more money to the reserve system to purchase sovereign debt from these countries. And then you also have the issue of the banks and the investment houses from Europe who had large exposure to some of these peripheral countries. But it looks like, you know, we've got this little reverse head and shoulders. If you can see this, this would be the head, the shoulders here. It looks like we've got an inverted head and shoulders here. And on that note, we could see the euro, you know, retesting the 132.50 area over the coming days. But bear in mind that this is not necessarily a bullish formation by any means. We still have some negative momentum here to be concerned about. U.S. Treasury bonds, as stock market rallies, T-bonds tend to not do so well, and their safe haven attractiveness is losing its appeal, as well as the safe haven attractiveness of gold. Okay, so gold is losing its luster amid economic weakness, but the bonds are certainly not that attractive here on a long-term basis. On that note, we're going to advocate going long the high-yield debt and shorting the treasury market simultaneously, a spread trade, if you will. As you can see today, the municipal bond ETF is putting in another great day. The high-yield debt is leading. The treasuries are lagging. Okay, so let's take a look at a long-term chart, 10-year. Okay, we're at 2.06% for 10-year treasury yield. Now, long-term basis, that's almost insane. The rate of inflation historically is 3.1% since 1925 in the United States, and it actually we finished the year at about 3.1% inflation CPI at the end of the year. So the question then becomes, how attractive can a 2% yield on a treasury bond be when inflation is 3.1%? I mean, that's a negative yield, a negative return of 1.1%. I'm not saying you should be out of bonds totally, but I'm just saying you don't want to be in treasuries. You want to be in something that's going to give you a little more yield and protect you from the rate of inflation. Credit bond, i.e. corporate bonds, are much more attractive to be in for conservative investors than treasuries. I don't believe you should be in treasuries or looking at treasuries for quite a while. Although it may not be the case that these rates are going to pop up immediately over the next 3 months or 6 months or even a year. It may even take another year or two for this sort of to grind its way out until inflationary pressures present themselves again. I mean, we have to seriously add some more jobs. We still have to contend with recessionary pressures in this country and globally as well, in Europe and the United States particularly. But with the rest of the world motoring and giving us some support, it seems rather unlikely that yields could be hanging out at 2% on the 10-year for much longer. Eventually they're going to have to come back up. All right, let's take a look at gold, because it's losing its luster, and something to take a look at. On the let me scrunch this in a little bit. It's kind of like been out here for, we're around this area of 161.94 on GLD. Sandwich, you know, is it going to crater down here, crater down below this area? Hard to say. We've got some positive momentum still on the monthly chart. The linear regression 50 and 100, we got some positive momentum here. So, you know, maybe we hang out in this range, but I don't think anything, I mean, if you're going to, you know, bet that it stays inside of a range, it's maybe not a bad idea to put in some sort of a a range bet trade, although I'm not very big on credit spreads. I don't believe in credit spreads directly, especially condor type of trades, unless you really know how to adjust your positions and you're very experienced with the Greeks. Okay, take a look at silver while we're at it. Okay, silver on the monthly chart first. Work our way into the micro from the macro view. Again, we're sort of sandwiched into this area. Looks like we're in a consolidation area here. See this wedge formation on the long-term chart, ever so slightly, but reducing waning positive momentum. And there you see it on the weekly again, hardly any direction. And be mindful of the breakout, whether it breaks up higher or lower. That's the key trade. Better way to play this is just stay aside, not do anything for now, and then wait for a potential breakout of this wedge formation at some point later this year. The USO is the ETF for oil futures, and it's not a futures contract by any means, but it is comprised of futures contracts to emulate the price of oil. Okay, so let's take a look at the bird's eye view first. Okay, we've essentially been basing out in this range here for a couple of months, actually years. Look at this, since 2009 we've essentially gone nowhere after spiking up. Remember in 2008 when we were worried about the supply of oil from the Middle East and threatening cutbacks of the supply and touching the energy reserve in the States and all that. Well, that subsided. They finally got the message across that if they don't keep the flow of oil going, keep the supply of oil going, then alternative sources are easily going to come into the picture. So hence they've been keeping the supply flow quite steady for a number of months. So we don't see any imminent potential threat from the price of oil spiking, which is also a plus for stocks. Summary, say that the Dow is approaching the key target resistance area of 13,000. If and when that point is reached, we'll keep you posted on any developments. Didn't have that much time to cover certain things that I wanted to. For instance, this is one of my favorite spreadsheet for the stock market. Tends to work pretty well. It's been long since December 20th. Swing signals for these respective benchmarks has also been pretty much predominantly bullish since December 20th. So we like stocks here for the interim. Of course, this can change at any point, given any sort of pullback and correction, but we don't see those forces in play at the moment. Thank you for listening and tuning in. I appreciate your feedback and comments, so why don't you drop me a line at proactinvest.net and sign up for free tutorials, and if you're interested in any of the other services we offer, please have a look and drop us a line when you get a chance. Thank you so much.